Credit cards are another product offered by retail banks. Credit cards offer the convenience of paying without cash, but unlike a debit card, they act as a sort of bank loan. Customers apply for a credit card, and approval is based on their creditworthiness via a credit report. The application and approval process happen almost simultaneously, as it is an automated process. Based on the credit rating of the customer, the bank will offer a set monetary limit, and the customer can spend up to that limit. The customer will then have 28 days to pay from the time they receive their credit card statement for the purchases made during the period. Over time, as a customer proves creditworthiness through using the card and paying the amounts owed, the monetary limit set on the card can be increased. A point of note to make: customers aren't required to pay the amount owing on the credit card statement in full. They can make a minimum payment, which can be a small fraction owing on the card, and then they can continue to use the card so long as they don't exceed their credit limit. Credit cards are, in essence, a form of revolving line of credit, which is a product that we will cover a little bit later in this lesson. Credit card products are highly competitive, as they are a great revenue generator for a bank. And as such, there are a large number of incentive programs offered to try to attract customers. These programs can range from offering a certain percentage of cash back on purchases made, or perhaps a customer can accumulate miles or points on purchases that can be redeemed toward travel or merchandise. Credit cards also will usually have an annual fee associated with them, depending on the reward program chosen or certain other features of the card. Where a customer may not be incentivized or enticed with these other perks, many banks will also offer a basic card that has no annual fee. Banks earn money from debit and credit cards in a number of different ways. We've already mentioned a couple of them, such as ATM banking fees and annual fees charged for credit cards. But they also earn money as customers use those cards. The merchant selling the goods or services to the customer is charged a fee in order to be able to accept the cards as payment. Also, with credit cards, the interest rate set on those cards is substantially higher than if a customer was to get a simple loan. Interest rates on credit cards might be as low as 8%, or often as high as 24%. For customers who carry a balance on their card from one period to the next, the interest revenue earned by the bank can be significant, and this is why the credit card market is so competitive. In fact, a recent study conducted in the U.S. found that 55% of people who have credit cards carry debt, and of those, 22% carry an average balance of between $100 and $500. Further, the study noted that about 1 in 10 people say they carried a balance over $5,000. For this reason, many credit cards will be offered at a 0% APR, or annual percentage rate, as an introductory rate for a period of time, usually around 12 to 15 months, just to attract the customer. That's because most banks know that once a customer gets accustomed to their card, there is a greater reluctance to switch to a different one. Let's break down credit card interest rates a little further to determine how interest is calculated. APR, annual percentage rate, is the standard way to quote an interest rate when banks lend money to borrowers and earn interest. The APR includes more than just the interest rate. It can also include the effects of the other costs and fees depending on the bank. However, in this case, let's assume the costs and fees are quoted separately, especially since credit cards will have an annual fee charged separately. APR is calculated differently in different countries. For example, nominal APR does not include compounding. This is what's used in the United States. Effective APR does include compounding. This is what's used in almost all other parts of the world, including the European Union and the Commonwealth countries including Canada, the United Kingdom, and India. So now, if the credit card has interest compounded, then the effective annual rate quoted will depend on what the compound period is. The effective rate is calculated as 1 plus interest over the number of compounding periods to the power of the number of compounding periods minus 1. The example shows the effective rate where interest is compounded weekly. A 12% interest rate that's nominal remains at an APR of 12%. However, when compounded, we can see the difference. When compounded weekly, the 12% interest rate has an effective APR of 12.73%. If compounded monthly, the APR lowers to 12.68%. Moving from credit cards, let's now look at credit products that are likely more familiar as being related to retail banking: bank loans. Within retail banking, there are two classes of loans: consumer finance and mortgages. Starting with consumer finance, there are two loan types: point of sale, or POS loans, and personal loans. A POS loan is the next step away from a credit card. It's used where a customer may want to buy a product that is more expensive than a typical purchase. Think about furniture, electronics equipment, and home appliances such as a refrigerator or a washing machine. A POS loan is essentially an instant approval loan, where the loan is approved right before a sale. POS loans are offered at the retailer's place of business, including online retailers. The retailer will have a POS system connected to one or more lenders. When the sale is made, the retailer will offer a loan that allows the customer to pay off the purchase over time instead of paying for it in full at the time of purchase. If the customer chooses to finance the purchase, the system automatically contacts the lenders and an instant credit approval is given, much like a credit card. The difference between a POS and a credit card is that the POS finance loan has a set interest rate, a set monthly payment, and a set repayment period. The loan term can range from a few months to a year, depending on the retailer and depending on the amount of the loan. A personal loan, on the other hand, is a loan that requires the customer to apply directly to the bank and get approval before a purchase is made. Personal loans are made for much more expensive items, such as to buy an automobile, pay for a wedding, or perhaps pay for a home renovation project. Personal loans are also often used to consolidate debt. For example, if a customer has been using a credit card or often multiple credit cards and hasn't been able to keep up with paying off the balances each month, the monthly interest payment can be substantial and, for some, financially devastating. A personal loan can be taken out in order to consolidate all of the credit card debt and pay it off, switching the customer's debt from a revolving loan with a double-digit interest rate to a fixed-term loan with a repayment schedule of fixed monthly payments at a far lower rate, usually under 10%. There are also personal loans that are in the form of a line of credit and are called PLOCs, personal line of credit. Credit cards mimic PLOCs in that the line of credit revolves. The difference is that the application and approval process is much more formal, and drawing from the credit line is not as easy as it is simply to use a credit card. The bank also usually requires the customer to have a checking account that will be linked to the credit line, and it monitors payments to ensure the customer continues to pay down balances. However, a line of credit has a much lower rate of interest attached to it. PLOCs are considered unsecured loans, much like credit cards are. This means that if the customer defaults on the loan, the bank has no recourse to recover that loan. There's another form of personal line of credit that is secured by equity in a customer's home. These loans are called home equity lines of credit and commonly go by the acronym HELOC. A HELOC limit will be set based on the home equity available. The advantage of a HELOC is that because it's secured by the borrower's home, the interest rate is lower than a regular PLOC. From the bank's perspective, if the customer defaults on the loan, the bank has the right to recover through the repossession and sale of the borrower's home. The final type of credit product we'll look at are mortgages. Mortgages are loans that are used specifically to buy real estate, such as a house or a condominium, or any other real property used for personal use, such as a recreational property. The mortgage loan requires assignment of title to the lender as security. This means that in the event of default, the bank takes title of the property and will sell it to recover the unpaid portion of the mortgage. There are a variety of different types of mortgages offered by retail banks. The most common mortgage will be a fixed-rate, fixed-term mortgage, where there will be a blended monthly payment of principal and interest. The interest compounds, usually semi-annually, and at the beginning of the repayment term, the interest portion is higher than the principal. But over the life of the loan, as it's being repaid, the interest portion decreases and the principal portion increases until the loan is finally paid off. Fixed-rate mortgages have a fixed interest rate attached to the loan for the entire loan term. It remains unchanged. These mortgages are popular in times where interest rates are highly volatile or in an environment where interest rates are expected to rise. A floating rate mortgage is one with variability. We start with a base rate, such as prime or LIBOR, and add an additional percentage, often 1 or 2%. The interest is adjusted frequently, often quarterly. These mortgages are popular in an environment where interest rates are expected to decrease. When deciding between fixed and floating rates, the term of the loan also becomes important. The longer the term, the more unpredictable interest rates are. For that reason, borrowers are more likely to choose a floating rate when the loan term is shorter, say 2 years, than when it's longer, say 5 to 10 years. Interest-only mortgages provide greater borrowing amounts relative to monthly payments. Only the interest portion of the loan is repayable over the term. However, there will be a secondary means required to repay the mortgage at maturity. For example, either through a remortgage, through selling the property, or through the maturity of an investment, one that was earning a higher rate of interest than the interest being paid on the mortgage.